Alright, welcome everyone back to another video. In this video, we'll be covering what is technical analysis, fundamental analysis, trend lines, support, and resistance. So, yeah. In order to master forex trading, you must first develop an understanding of both types of analysis and the different types of strategies. It is advised to open a demo account to learn how to trade and how it will affect your balance. A demo account is the same thing as a live account, but the only difference is that the money is not real. So we use demo accounts to interact with the market and test strategies without losing any real money. Only once you've dedicated the time needed to understand your strategy, then you make the switch to a live account where you can replicate the same winning results. Meaning, if you can turn a $1,000 demo account into $10,000, then you just replicate those same winning results on the live account, and you make real money. So basically, you invest your time into developing the knowledge needed and avoid losing or wasting money, because most of the time, people enter forex without proper knowledge and end up losing real money, and they think it's a scam. So before we continue, I believe it's important for me to explain the difference between trading and gambling, because gambling is betting and over leveraging, and trading involves statistical prediction using both technical and fundamental analysis, as well as proper risk management. So before we go too deep into the technical analysis and fundamental trading, let's define what is forex trading. So it says here that forex is short for foreign exchange, and it is basically the act of exchanging one country's currency for another. So pretty self-explanatory there. Next, we have what is traded in forex. To put it simple, money. You can think of it like an airport or cambio, where you exchange one country's currency for another. The reason why some people do this is to profit from the difference when the currency goes up or down. So they're basically just buying and selling one currency for the other for profit. Here we have technical analysis. What is technical analysis? Well, basically, it is the study of the charts using price action. That is, the historical price movements to determine the current trading conditions and potential price movement. So that's saying we use what happened in the past to help us predict or determine the direction of the market, up or down. That's it. History tends to repeat itself, or at least rhyme. So if an area acted as key, support, or resistance in the past, it is likely to do so in the future. Technical analysis includes formations and patterns. So if you can identify formations and patterns that happened in the past, then it's more than likely to occur again and play out similarly. Here we have fundamental analysis. So the basic explanation for fundamental analysis is analyzing the social and political economic factors that affect the forex market. Understanding the reason why and how certain events such as unemployment rate affect the market is key to fundamental analysis. In a nutshell, the idea behind fundamental analysis is to use the current and future economic outlook of a country's economy to help us determine the directional bias of a country's currency. To put it simple, it's using the news to determine whether we want to buy or sell. For example, if unemployment rate is low, then it's more than likely that the currency of a country will go up, because you have more people employed, so the strength of the currency and it increases. So now that we know that fundamental analysis involves the use of news and other economic events, and technical analysis includes the use of historic data, We can now touch on how to apply these different types of analysis to the charts to help us determine whether we want to buy or sell. However, before I do so, I believe it's important to have a quick definition of terms. A resistance zone is an area above the current price where the price has reversed or respected in the past. I have a visual representation of what a resistance is supposed to look like. I'll explain that in a minute. A support zone is an area below the current price where the price has reversed or respected in the past. So a resistance is located above where the current price is. A support is located below where the current price is. And trend lines are diagonal lines used to identify patterns and predict price movement. We have a representation of what a resistance zone would look like. That would be the blue rectangle above here. So these arrows represent the price movement, as in the direction of the candles. So let's say the candles were generally moving up to this area, touched right there, bounced off of it, then we can draw it up everywhere that the price bounced off. That there would be considered a resistance zone, and it's a good area for selling because we know that when price approaches a resistance zone from below going up, it will either reverse or break through. More often than not, it will reverse at a resistance zone. So support zone is basically the exact thing in the opposite direction. Is just below where the price is. So if the price falls and approaches a zone where it cannot break through, that area is considered a support zone or support line if you want. But it's advised to use a zone to have a more precise area to work with. Yeah, you'll have more precise calculations using a zone instead of a line, because sometimes the price can go lower. If you notice, this representation of price movement is showing that, sometimes the price goes a little bit lower each time or higher, but as long as you have a zone and it stays within that zone, then you're still accurate. And for trend lines, we have a downward trend line here. It's basically just connecting the tops every time you have a lower high. You connect them and then you'll have a trend line or zone as well. And you have a upward trend line as well, where you connect the higher lows. So for a downward trend line, we connect the lower highs, and for an upward trend line, we connect the higher lows. I'll illustrate how we identify these trend lines and how we apply these trend lines onto the charts a little bit more. So in the most basic form, we have our upward trend line and downward trend line. And like I said, an upward trend line is drawn along the bottom of the easily identifiable support areas. So here we have support areas located here. Sorry about that. Here and here. And we simply connect the dots. It's a lot like connecting the dots on the charts. You'll see different shapes and so on when we get to the charts in a minute. But the general idea is to connect the support areas or the higher lows that you'll have going in an upward direction, and by connecting them you'll have an upward trend line. The use of this is to predict where, when the price goes up, where it will be coming back to. So in such cases, after identifying a strong upward trend line, let's say by the second touch here, coming down for the third touch, we would have confirmation to go in for a buy order. When price comes back to touch our trend line, we simply open a buy and we watch it bounce off of the trend line like it has done in the past. And for the downward trend line, it's simply drawn along the top of the easily identifiable resistance areas. So all of the lower highs, you simply collect the dots, and that's giving you confirmation to sell. So let's say at the second touch there, we would know that our trend line is heading in this trajectory. So when the price comes back to touch the trend line, then we're expecting a bounce and a push in the downside, so we can sell here or sell there. We can sell here or sell here. Yeah, so hold on, actually. Alright, so we sell here. Yeah, and we sell here. Look, right here. Yeah. So if we head over to the charts here, you'll notice that I have a channel drawn up here, and a channel is basically two trend lines, both at the bottom and at the top. You can have this an upward facing channel or downward channel. It's just two upward trend lines or two downward trend lines. So here we have a trend that I've identified, and like I said, to identify a trend in either direction for upwards trends, we look for higher lows. So this is a low period in the market, this is the market's other low, and so on and so on. And what I've done is connected the lows with a diagonal line, and that gave me a sense of where the market would be coming to if it chooses to come back down or rebound off of the top trend line as well. So it's showing where it's coming from as well as where it's going to, or where it potentially might go in the future. So that's how we mark up an upward trend line. And for a downward trend line, for example, we can connect it's really important for you to understand how to properly place trend lines. A trend line can just be this, actually, yeah. So I've identified a trend right next to our channel, before the channel actually, and so the general idea here is we've identified a high, a lower high, another lower high, and then another lower high. So we were able to draw up a downward trend, and to make it a channel, you just hold your control key, you click, and you drag it out, and you can see a channel like that. You can edit it to see where it's gonna go based on the support touches as well. However, just focusing on the downward trend, we can notice here that when the price touches the trend line, it tends to fall. Every touch, you have some sort of drop in price. So this is how to identify trends and set up trends. For upward trends, we look for higher lows, which is the lowest point every time the chart decides to go up and down, which is the lowest point on it. And for downward trends, we look for the lower highs. So the top of the candles, as long as they're not passing the previous top, then that's lower lows. The opposite for this one, When it's going up, as long as it's higher than the previous lows, then that's considered a higher high. Alright, and that's it for this video, and I'll catch you in the next one.